we can go back up. But what I do want to point out to people, we went up 40% in gold in a year from the beginning of the year to the height. This is not Bitcoin. Bitcoin is just a high-flying speculation. They can call it whatever they want. They claim it's going to be a reserve currency and all. Gold is a monetary force. Doesn't normally, nor is it really good for it to go up 40, 50% every year like that. So it was quite healthy. And for anyone like me who still believes we're going to be north of 3,000 before it's all said and done, and could be possibly a lot more than that, we needed this correction. It was basically a semi-parabolic move up.
Market expert Peter Grandich has deemed gold's recent pullback a healthy adjustment, particularly for those who believe the precious metal could eventually surpass $3,000 per ounce. Ongoing market dynamics bolster this optimism, including central bank purchases and the Federal Reserve's expectations of a rate-cutting regime. On Tuesday, gold prices climbed for a second consecutive session, reaching a one-week high. The U.S. dollar's retreat from recent peaks supported the rise, while investors awaited guidance from Federal Reserve officials regarding future interest rate policies. Analysts note reduced expectations for aggressive rate cuts could limit gold's upward momentum, but the overall trajectory remains positive. Wall Street forecasts suggest that gold could reach $3,000 per ounce as early as next year, driven by central bank purchases and a favorable monetary policy environment. These trends are further amplified by geopolitical uncertainties, including the potential fiscal challenges a new Trump administration poses. Analysts speculate that heightened concerns over the U.S. fiscal position might prompt significant holders of U.S. bonds to increase their gold reserves. Grandich highlights that gold's earlier rise was somewhat parabolic, fueled by the anticipation of BRICS-related developments and robust central bank buying. The buy the rumor, sell the news effect following the BRICS summit and a slight easing in central bank purchases contributed to the pullback. However, these factors have not altered the long-term bullish outlook for gold. The broader context of de-dollarization also plays a critical role. While the U.S. dollar remains dominant, the de-dollarization agenda initiated by the BRICS alliance is gaining momentum. This shift underscores the challenges facing the dollar's supremacy as countries increasingly diversify their reserves into alternatives like gold. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
So right at the height of the BRIC meeting, I decided that, I've been long gold since 1300, that we were going to have a sharp but fairly swift and not long-lasting correction. And I used it to take some profits. Thankfully, last Friday, I expressed that I thought that the bulk of the correction was over and that, we can go back up. But what I do want to point out to people, we went up 40% in gold in a year from the beginning of the year to the height. This is not Bitcoin. Bitcoin is just a high-flying speculation. They can call it whatever they want. They claim it's going to be a reserve currency and all. Gold is a monetary force. It doesn't normally, nor is it really good for it to go up 40, 50% every year like that. So it was quite healthy. And for anyone like me who still believes we're going to be north of 3,000 before it's all said and done, and could be possibly a lot more than that, we needed this correction. It was basically a semi-parabolic move up. And quite frankly, the two things that were leading it up, the BRICS happened. So, this buy the rumor, sell the news, and also the central bank buying eased a little, not to where it's changed, of course. And then, of course, the Trump win initially, people view was even more negative because the dollar rallied. He's going to be a Bitcoiner. He's not going to be a gold supporter. But gold, again, as you and I speak today, up nicely. I think it's up also because can I just stop and tell you the complacency in my 40 plus years, both by professionals as well as individual investors, is off the charts compared to the fundamentals out there. When today, we're probably the closest to a nuclear crisis since the Cuban Missile Crisis in the early 60s with Kennedy. And you would never know that if you were listening or the talking heads on Wall Street or the average investors going to wipe out even if you own gold. But it's really alarming that people have pushed something like that aside at a time when really those type of things should be even less handled by this current administration because you're a lame duck and basically put any of those decisions. Listen, if we haven't allowed Ukraine to shoot these missiles by now, and it's November 19th, what's 2 more months? Let the new presidency come in and let them handle it, so to speak. And some are arguing, I think it's a good argument, that this is a way of creating more problems for Trump than trying to help things get better.
As the 2024 holiday shopping season begins, Americans face record-high household debt. According to the Federal Reserve Bank of New York's latest report, total household debt rose by $147 billion in the third quarter, reaching a new record of $17.94 trillion, an increase of 0.8% from the second quarter. Credit card debt also hit an all-time high, climbing by $24 billion to $1.17 trillion, an 8% increase from a year ago. Families continue to grapple with inflation's effects on their budgets, contributing to rising debt levels. Overall, debt delinquency rates rose from 3.2% to 3.5%, encompassing all types of debt, including mortgages and auto loans. However, there was a small positive sign in credit card delinquency rates, which decreased slightly from 9.1% to 8.8%. At the same time, concerns over national debt are mounting. Financial expert Peter Grandich highlights that U.S. debt will reach $50 trillion within the next decade. With a 5% interest rate, annual interest payments could total $2.5 trillion, equivalent to half of the federal government's current revenue. This level of debt servicing raises questions about the sustainability of government operations and long-term fiscal stability. Let's get back to the interview.
Well, first of all, we've given a good part of that back now. Between last week and today, a good part of it. We're also seeing a lot of internals, I think, breaking down as well. I think the market has been up, and like I said, it gets a benefit from Thanksgiving to New Year's, that people kind of look at the cup half full no matter what until the new year, and then of course they go back to being themselves. There's two things I think that have kept it going. One is all the excitement in the Bitcoin. Now everybody's excited. Bitcoin's 92,000. Had peaked at 70 something. It's not a huge move given where it was just a couple of years ago, but everybody and his mother says it's the next best thing. There's hard to find anything negative about it. I keep saying it won't peak until they announce it cures cancer. Then, of course, we'll know that we've reached the ultimate peak. But I think the thing to be concerned about, whether you're a bull or a bear, is what happens with interest rates here, especially coming into another period where the Fed is expected to cut interest rates again. 10-year Treasury bond has actually increased almost by a full point from before the first cut in interest rates. And it's up in an area which I keep targeting, and we got right up to it again, the 450 yield area. And if we get much above that, I do think it's going to cause a huge problem no matter what period of time of the year is for the stock market. For one, for those that still treat stocks as stocks and bonds and not one big casino, there is some valuation models now that suggest for the first time in a couple of decades, bonds are actually getting more attractive than stocks, comparing one to the other. I also think that we're going to continue to see Trump, no matter what other things he may do well, be as big as a spender, if not more, and increase the debt up tremendously. And I think that's concerning that the Stanley Druckenmillers, the Paul Tudor Jones, and some of the smartest people who I'd give my money to tomorrow if they were manager for me. And that is they are going negative on the bond market. They're becoming a word that I haven't heard since I first entered the business in the early 80s. And there's a great concern about the talk that's been around for decades in the gold market, but it's finally come to the bond market. And that is the ability for this country to pay off its interest. We're heading to 50 trillion. The Congressional Budget Office says we're going there in less than 10 years. A 5% interest rate, 2.5 trillion in interest expense. Best year we ever had was 2022 in revenue. It's a little about right on the 5 trillion mark. We can't sustain the government as we know it, no matter how many cuts and excess waste that they get rid of, which I think is going to be a challenge for them, by the way. But nevertheless, we won't be able to pay half of our income to interest and still have a government that we've grown accustomed to and all. So I think the stock market pretty well was in a mini melt-up right up through the election and for a few days, but it's given most of it back. And like I said, if it wasn't for the seasonality of having positive, I'd even look to short it, but I just know that I too will not be bah humbug until after the 1st of January.
Rising household and national debt underscores significant economic challenges, highlighting the importance of safeguarding wealth during periods of uncertainty. As debt pressures mount and fiscal sustainability comes into question, tangible assets like gold may provide a viable strategy for preserving value amid potential market volatility. How can investors effectively adapt their strategies to navigate rising debt levels and potential fiscal challenges? Share your perspective in the comment section. If the video resonates with you, Join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.